Chapter 2. Your Introduction to Options. In investing, what is comfortable is rarely profitable. Robert Arnott. While it may not seem like it, if you look at what derivatives did to the economy a few years ago, this type of investment was actually created to help reduce risk and give investors tools to protect their investments. Options are a good example of this. Options are a contract between two parties. Like futures contracts, they involve one party selling the option of buying a certain item by a certain time to another party, and another party being able to buy that item by the specified date. But they don't involve commodities. Instead, they deal with investment vehicles such as stocks. Suppose you own 100 shares of stock ABC Company, valued at $50 a share. You owned these stocks for a year or so, having originally purchased them for $40 each. You're concerned that an upcoming announcement may cause the value of those shares to drop. So, you want to take out some insurance on them to protect your gain. One thing you can do is to write a contract giving someone the option to buy those shares if the price falls to $45 a share. This way, if the price of the stock drops, you've protected some of your profit. If the stock price doesn't fall, the option expires on the date agreed upon in the contract. You're only out the cost of the contract, so you've given up a little bit of your profit, but you had the protection of the option during the time period you were concerned about. Another way you can use an option as an investment tool is to sell the option to buy your shares at a certain price by a certain date. Since you bought those shares at $40 and they're now worth $50, you can write a contract to sell those shares for $52 per share. If the price of the shares goes up past the price in the contract, known as the strike price, the other party can buy those shares for less than their current price. If they don't hit the strike price by the time the option contract expires, you still have your shares. Plus, you keep the money the other party paid you for the option to buy your shares. Investors use this technique to make extra money off their shares, but at the risk of losing those shares if the price rises past a certain point. Of course, if the value of the shares goes down, the other party is out the cost of the contract, and you've suffered the decline of the share price, offset somewhat by the money you received for the option contract. So far, we've looked at fairly conservative uses of options. They can, however, be used in ways that offer the possibility of great reward, but with greater risk. It is this type of options trading this audiobook focuses on. You see, the options you learned about in the preceding paragraphs are known as covered options. This means that your options contract is protected by the shares of the stock, or financial instrument, you own. If, for instance, the share price goes up and the option buyer chooses to execute their option, you are required to sell them those shares, or the equivalent, for the contract price. In a covered transaction, you already own the shares in question and simply turn them over to the buyer. In fact, many times, you'll be required to commit the shares you own to the option. It has to be done on the same day you buy the shares and have to inform your broker about the joining of the shares and the option. This is referred to as a married option. Uncovered options. But what if you offer an option contract enabling the other party to buy shares of a particular stock at a particular price when you don't actually own the shares? Yes, you can do this. It's a riskier transaction, though. Now, if the stock fails to reach the strike price, you get to keep the fee that you were paid for the option and the option's buyer loses their money. The danger is that the stock might rise in price and the option becomes executed. Now, you're out the difference in value between the strike price and whatever the price reaches when the option is executed. Since there is no real limit as to how much an asset can rise in value, there's also no real limit to how much you can lose as well. If you sold an option to buy a stock for $42 when the stock was trading at $38 and the stock reaches the strike price, you're now out $4 a share, minus the money the buyer paid you for the option. If the option were for 100 shares of stock, you'd be out $400 if you owned the stock when it was worth $38 per share. But in the case of an uncovered or naked option, you don't.
To keep listening to this audiobook, I've left you a link in the description so you can do it at no cost thanks to Audible's 30-day free trial.